Marty, you've done a great job, and obviously, your group has been terrific over the past decade running these meetings, and you put such amazing teams together like I have today. I'd like to also thank K&L Gates for giving us the conference room and providing, obviously, this forum for IvyFON as they've done numerous times. So, a couple thoughts that we've been thinking about as a team because we met recently through Zoom is that one of the key objectives for most family offices is long term generational wealth. Real estate, which is our topic today, is that tangible nature, is that tangible asset that gives you that appreciation, that gives you that safe asset that family offices are looking for. So, real estate's an on ramp, and there's a lot of different on ramps to get there. If you're a new wealth owner and you're a family office today and you're watching this, you are coming from possibly technology. You get tech, but you're not really sure about real estate. Maybe you're a second generation real estate owner and now you're just advancing your real estate portfolio. I think you're going to get a lot out of today. Or if you're just looking for a good perspective to understand what real estate is and how it adds alpha to your portfolio, I think today is going to be a perfect afternoon for you. So I'd like to make a couple brief introductions, and then we're going to go right to Q&A. So, on my screen to my right, I see my good friend Pravna. Pravna, how are you?
Doing well, thank you.
Good. So your audio is working beautifully. He runs an amazing management firm. He's been there for almost 19 years. Nihilus is, which is part of his Bhakta capital firm, and he's a hospitality consultant. He's done over $3 billion in hotel transactions. So I think we're going to get a lot out of him. And what's nice is he's in the middle of building in over 50 different extended stay hotels throughout the US. So I think regionally we're going to understand a lot about him. Also on the panel in front of me is a good friend, Ken Kecskes. He's a lawyer. And what makes him great is as a business lawyer, understanding real estate and putting that together makes a huge difference to all of us that are in this business. He's got a background in private equity, real estate, land development. He counsels family offices. So he's somebody you really want to go to. And he's been doing this for 25 years. So Ken, can I hear you? Just make sure that you're coming through okay.
Right here. Thank you.
Perfect. My pleasure. Dr. Larry Souza and I have known each other for quite a while. Larry, how are you? I think Larry, as an economist, he's been doing this for over 19 years with his own firm. He brings a tremendous amount of information to the table, and he'll help us a lot understanding the Fed, understanding what type of loan amortization we should be thinking about, what type of LTVs we should be thinking about, who should we be borrowing from. He'll really conceptualize that for all of us. And then obviously my good friend Ken Nitzberg. Ken is chairman and CEO at Devon Self Storage, founded the firm in 1988. I think what's great about Ken is his great understanding of today through the last 3 years of this massive demographic shift. And storage has been a huge game changer for him and the economy because as the baby boomers have gotten older or they've left their place of work, what do they do with their stuff? They go home, they're not in the office, and they need a place to put it. So Ken will give us a really good feel for that, having operated or currently operating over 103 self-storage facilities in over 27 different states. And then obviously Deborah Chan Mangan. Deborah brings a 20-year track record to us. Deborah has a very good, strong handle on debt. She works for a very large family office, and she's a real estate developer. So Deborah, why don't you expand on your own background, and I'm going to lead the first question with you.
Thank you, Matthew. For those bears in the room, I went to Cal undergrad and got my degree in legal studies and minor in accounting. And right afterwards, I worked at Arthur Andersen in the tax division. I may look young, but I'm actually in my early 50s.
Lies. No, I don't believe it.
Not true.
Heresy.
So as Matthew says, I have about 22 years now in debt and equity financing. And my expertise is now in construction financing and bridge financing. So between financing engagements, I look for my next investment. And I'm also a young developer, having redeveloped a couple of properties in Dallas, Texas in 2017 and 2018. And in developing my future multifamily projects, I like to use a proven industry disrupting eco-friendly construction technology. So in the last 2.5 years, I've been working with a a fascinating international family office that's in the business of providing private credit financing and some equity for large-scale commercial real estate construction projects and bridge loans. Our average loan size is about 125 million, minimum being about 15 million, but we're flexible. And I'm an exclusive correspondent for this family office. And so I originate loans, and I also serve as a consultant to them in performing due diligence and pre-underwriting for their deals. Thank you very much.
Fabulous. No, of course. So, I know that you have one client, and that one client is key to obviously your background, your business, and what you do. So, you providing, information to their investment policy statement and what they should be doing is paramount to their growth as an investment firm themselves. So, let's talk about last year. There's blood in the water. There was blood in the water in 2023. Commercial real estate loans, were in big trouble. The LTVs have changed drastically. The ability to find a good cap rate has been blown out of the water. Lower valuations, higher caps. So my question to you is, did the knife fall hard enough and fast enough last year to clean out all the garbage that's left?
We've got a long way to go, unfortunately. So according to CBRE, they anticipate that cap rates will, in general, for all asset classes, increase 25 to 50 bips, which translates to an average of 5 to 7% decline in asset values. And some analysts think that it's actually higher, 20 to 30% decline in asset value. So now multifamily is still a favored asset class. They anticipate the cap rates will increase 75 to 100 bips. So there's several dynamics, and one of them is the huge housing shortage. We're still about 3.8 to 7 million
address
units.
The blood in the water. Address all the bankruptcies that are happening, the distressed debt that's out there, the bankers that are looking to unload portfolios. That's really what I'm leading to in that question.
Right. So within the last 10 years, we have a humongous appreciation. That number is astonishing. Look at my cheat sheet there. It's absolutely astonishing, 125% appreciation. So there's a lot of equity built into these properties. So lenders are not in a rush to go forward with foreclosures. They're laying low. They're letting borrowers work out finding creative solutions. And with borrowers, there's a lot of equity also built in for them. And hopefully they've cashed out a lot of equity over the years and have more to put towards a refinance if their mortgages are coming due. Does that answer your question?
Yeah, I think you're right on track. And Ken Kecskes, let's go to you. Let's go about an area that could be exciting, I think, for the Bay Area. Talk a little bit about how life science and real estate in the Bay Area is moving in a really positive direction. So speak to that if you don't mind, and maybe a little bit more in your own background.
Yeah, happy to do that. And just quickly, I'm in the real estate land use practice here at K&L Gates, and welcome to everybody who's here and online. With respect to life sciences, that's one of the food groups in the real estate market that continues to be very attractive and successful, and it's very relevant to this conference. I mean, we've seen just right in the middle of the pandemic, Genentech received approval for expansion of 4.5 million square feet of additional life science related work. Amgen also signed a lease for 245,000 square feet in the Bay Area. Invesco also has biotech campuses here in the Bay Area. Astellos just agreed to build 154,000 square feet facility here in the Bay Area. Even in Vacaville, which isn't really the Bay Area, right? Entitling in advance $3.5 million, 3.5 million square feet of space for potential biomanufacturing. So this is a future opportunity for family offices. It is a space that is still currently active. It's not a work from home business, so it's going to provide stable returns. So it's something that I think should continue to be of interest to family office investors, whether as joint venture partners to local sponsors, or in collaboration with some of these smaller companies, like we just heard from the guy from Debut, who are innovating, and in San Diego is another market here in California that is, progressing rapidly and moving forward, with a giant campus in downtown San Diego devoted to life sciences. So that would be kind of my input on that, the excitement of that space for family office community.
Thank you. And is there anything about your background, Ken, that you'd like to add? I know you got your JD at the University of San Diego, and I know that this is a space you've been in for the last 25 years, helping not only private equity but family offices.
Yeah, I think what I'd add is, my practice is kind of, I like to call it ambidextrous in a way. And what I mean by that is that it's half of it is transactional activity. So helping clients buy, sell, lease, finance, joint venture. I do a lot of work with inbound investors coming from all over the world, frankly, in China, South Korea, and Europe. And then the last part of it is development transactions. So I walk projects through the paces. And, one of that would be for our corporate clients in the life sciences area, or as Deborah mentioned, multifamily. And, if we have time, and I know we're all tight on time, we can talk about the opportunity in the housing sector maybe later.
And are you located right there in the San Francisco office where you are now?
I am here in San Francisco, yes.
Okay, so for all you family offices, just his doorbell is just a walk away. So let's move over to, of course, let's move over to Pranav. How are you today?
I'm doing quite well, thank you.
Good. Now you're coming in clear. So, I know that you've got a very big background in extended stay hotel segment hospitality. I'd love to hear what your thoughts are about why you believe, and I know you and I spoke about this, that the hospitality extended stay is such a great hedge against inflation. And we'd also love to hear a little bit more about your background.
Yeah, so let's it's about that time, so let's mix a little cocktail here in terms of why hotels, right? The base of this cocktail you can see from long-term trends. So U.S. hotel NOI grew at about a 5.5% compounded annual growth rate from 1970 to 2019. Outpacing inflation by about 175 bips. Okay, we're the only asset class where our unlevered yield is higher than every asset class levered yields, right? And so we can do that because we're a daily lease business, and that is our hedge against inflation on at least top line, right? Because we have the power to change the rates daily, very dynamically, because this is an operating business plus real estate. So revenue management and dynamic pricing that the airline industry has been using for decades, but now other industries are using quite regularly, has been implemented in the hotel business. So we are allowed to, again, push rate. I can tell you today, given the abyss that COVID created for our industry and the pent-up demand that exists for hotels, we have priced rate aggressively. For example, when we ended 2022, the hotel industry was up 14% from 2019. Occupancy was relatively flat. However, rate was up about 14% from 2019 peak. So we went peak trough to exceeding peak within 12 months. So most asset classes did not see that recovery. And there is still a lot of pent up demand that is still traveling for leisure. We all know the extended stay space, specifically was quite resilient during COVID because it caters to the essential workers that were still building roads, traveling nurses, so on and so forth, which still needed to travel in a temporary home away from home to do their work. And so the extended stay segment, and we saw a lot of institutional capital backing that thesis in terms of momentum play, whether that's Blackstone or Starwood, buying very large portfolios of extended stay hotels because they mimicked multifamily in terms of stability of cash flows. However, gave the upside of the transitory nature of hospitality in terms of dynamic pricing.
Wow, amazing. I mean, we're now going to push off of extended stay in hotel and go into another very intensive capital asset class where we're seeing a lot of institutional money flow. We're seeing hedge funds money flow and state money flow, and that happens to be storage. So we happen to have Ken Nitzberg with us today. Again, he's a chairman at Devon, founded Devon in 1988. And what I want to ask you, Ken, obviously, is that you have 18 storage facilities, under construction. And I was thinking about that. Do you ever de-risk your under construction projects by negotiating now with future tenants? And we'd love to hear a little bit more about your background.
Matt, you can't pre-lease self-storage units. I've been trying for 30 years. People come and rent them when they need them, or maybe the day after they need them. So no one's going to rent it a year in advance in anticipation of needing them. To answer your last part of your question first, we've been doing this for 30 years now. We currently manage 103 stores. I have 55,000 tenants, all on 30-month rental agreements, which is a whole different can of worms to manage. We have 18 more under construction around the country. What we do, our primary business, is what we call adaptive reuse or conversions. We like to buy vacant properties that have been vacant a long time so that there's, the weeds are now small trees and the glass is all broken and there's graffiti everywhere and there's raves and homeless people living there and drug labs. So that the city is happy to have someone come in and will give us zoning changes. And so we get great locations. We buy them for pennies on the dollar and we convert them to state-of-the-art self-storage facilities, fill them up and sell them. And we have averaged over 30 years a net, after all costs, a little over 15% IRRs forever. Whether it's highly leveraged or all cash, we don't own these. We are a management company. We own little pieces. But one of our bigger clients, for example, is the state of Texas Employees Retirement System. We just don't have the capital to go toe-to-toe with them and pari passu. So we put a little bit in so they know we're committed, and they put a lot in so we know we can do the deal. And we worked with many, many institutions over the years. Everybody thinks they want to get into the business till they see how capital intensive it is, or not capital, how management intensive. If you have 100,000 square foot industrial building, you have 4 or 5 tenants. They're on 10-year leases, and all you have to do as the owners make sure the janitor shows up to clean the restrooms and the gardener once a week to mow the lawn. If you have a 100,000 square foot storage facility, you have 800 units, you have 700 tenants if you're 90% occupied, and they turn over 80% a year. If you don't have your systems in place, you will get eaten alive. And not to argue with my friend in the hotel business, who I met Monday on a Zoom call, but if you look at the REITs and you use them as a yardstick, which I hate to do, because anytime you put real estate into a daily tradable asset, you kill a lot of its basic inherent benefits, in my opinion. My friends who run public REITs in the self-storage industry would disagree with that. But if you look at the REITs, all of them, the different categories, industrial, retail, multifamily, whatever, and you look at any 5, 10, 15, 20-year period, always number 1 or 2 in total return are the self-storage assets.
Ken, let me interrupt you. I've got
Sure.
the NAREIT numbers right in front of me. And
Okay,
for 2021, self-storage had an 80% return for 2021. I don't have the final numbers yet for 22, but that is a remarkable number for one asset class.
Yeah, we can't annualize that and run it out 10 years. We'd own the whole world. But beauty of compounding interest. Exactly. I was at one of Marty's conferences a couple of years ago, and one of the venture capital guys was saying we always get 50% or more. And I kind of scratched my head and said, "Why are you here? You should be, on the beach in Tahiti."
Right.
But in good times we do well, and in bad times we do well. The old joke was that storage was recession proof. It's not. The only thing that I can think of today that's recession proof is maybe beer. That's it. It used to be around cigarettes, but cigarettes kind of gone by the boards. But we are recession resistant. So in good markets, we do great. And in bad markets, we do okay. And so when you string a bunch of those together, you do fine. If you buy something for $1 and it goes to 50 cents in value, you need 100% gain to get back to even. That's a pretty good trick to do. But if you buy it at $1 and it's a terrible economy and you go to 90 cents, you need a 12% gain to get even again. So we make money, and my accounting friends hate this when I say it, we make more money on the expense side of the P&L than we do on the income side. And we're in a terribly unsexy business, not very exciting. I tell my friends we're in a self-storage business and they yawn, but it's been paying the bills real well for 30 years.
Well, the NAREIT absolutely, highlights that and tells us what those returns are. So, family offices that are listening today, or those of you in the room, at in the conference room, you've just heard two really interesting asset classes. You heard about hospitality and extended stay, and you heard about storage. As you're building your portfolio, those are two areas that you need to be thinking about. So let me move on to my good friend, Dr. Larry Souza. Larry, I know you're the director for the last 19 years at your own firm, which is the Johnson Souza Group. You have your PhD, and having you on the panel today, makes it my job so easy because when we talk about distressed debt, and real estate, and economics, and the Fed, it just seems like you really have a good handle on that. So my first question to you is, how does a family office that's viewing today, who's cash heavy, think about distressed real estate? And let's pick an easy asset class, multifamily, and get involved.
Timing. Obviously, it's all timing. You got to be watching I like to use TREP data. They look at the commercial mortgage-backed securities market. What you're looking for is widening spreads. As some of these mortgages start moving into default, they'll move through into the different tranches, and then the spreads will start to widen, and then there will be distressed debt opportunities in the CMBS market by the different asset classes or property sectors. Obviously, office, has gotten pummeled significantly. I mean, you look at the NAREIT index, for the office sector. I mean, I think it's down like 40%. The other asset classes in the NAREIT, Matthew, is down a little over 20%. But I would say that the apartment sector is probably going to be the most resilient and probably have the most narrowest spreads. But there will be opportunities to pick up some of that debt in some of those assets, probably within the next 12 months. The Fed's not done raising interest rates. They'll probably peak out within the next 12 months. I think we're at about 3.5 on the 10-year. Short-term interest rates are around 4 or 5. They're looking to target at 5 or 6 on the short end. The yield curve is inverted right now, which always predicts a recession. So we'll probably go into a mild recession within the next 12 months. But in 2024, the Fed's going to come in and start buying back a lot of that debt, sovereign debt, pushing up bond prices and pushing down interest rates. So that's like the best time is probably at the end of 23, early 24 to start picking up some of this distressed debt. And then once the Fed comes in and starts pushing down interest rates, you're going to not only lock in that higher yield, but as the interest rates start to come down, then you're going to get principal appreciation. So you could be looking at, depending on the sector, probably 20, 30, maybe 40, maybe even 50% return, particularly on the office sector. So I think it's you got to keep your eye open, time it, get in, when the yields are there, and then ride the interest rate path down through 24, and then get out, and
So
rotate your capital.
So for those family offices that are listening, you need to be huddling with your investment team, huddling with your investment partners, talking to, your money centers and think about, okay, when is the right time to deploy? I think to an individual in this room, there is no right time. You just have to constantly be in the market to enjoy that type of a run up. And if you're not in the market for real estate, you really need to be thinking about that. So, Deborah, you just heard, Larry talk about, a recession coming forward over the next 12 months. And in your view, if we are having a recession coming forward in the next 12 months, and let's say we're not going to break out until Q1 of 24, what asset classes are poised to perform?
I think number one, multifamily. Number two, industrial warehouse. And third, hospitality. Sorry, Parvan. As I mentioned, CBRE report is anticipating anywhere 5 to 7% decline in asset values, and a lot of analysts, as Larry mentioned, are thinking that it's going to be closer to 20 to 30% decline. So it's really a secular, depending on the asset class and not a cyclical change here. So with the housing shortage of 3.8 to 7 million units, it's still going to be, multifamily is still going to be the highest performing asset class. And here are some dynamics. The vacancy forecast for the year from CBRE is slightly up but still under a 20-year average of 5%. Rent forecast, they're anticipating an increase of 4%. And for multifamily owners and investors, they can adjust rent annually or monthly, really depending on the city. Now, I have a lot to say about industrial, maybe because I don't understand it as much as some of our panel speakers. It's so complex. So in industrial, with the e-commerce industry increasing, so does the need for warehouse and industrial space.
Well, wait a minute.
Consumers
You said
today,
that e-commerce is increasing. Think about all the e-commerce companies from Tesla all the way down to eBay and others, as well as Amazon, are laying off tens of thousands of employees. Do you really think that warehouses are going to be a place that we should be putting our money for family offices?
I think so. There's a lot of competing dynamics going on. These tech companies with the layoffs, they're more lean, trying to get their bottom line numbers to work out better for shareholders. But consumers really prefer still online shopping, and they want their products faster. So this is really important for last mile distribution. And e-commerce only accounts for 20% of the retail sector. So there's really a lot of room for growth. Now, for the biggest challenges for industrial sector is that there's, for 2023, labor shortage, rising construction material cost. So those pose the greatest challenges. And check out the deliveries. So look at the inventory. We have in the construction pipeline 713 million square feet coming this year. The deliveries of these industrial assets
Right.
are
So let me just
to
stop you for a
all-time
second,
high.
because we've got, FedEx is laying off, tens of thousands of employees. They're scaling back, their deliveries. They've just decided to cut off Sunday deliveries. So I think we're going to have to talk about industrial. We're going to have to talk about warehouses. We're going to have to talk about space. We're going to have to talk about build out. So I think you really hit a good nerve here today to figure out how to do this. And I think it's a perfect segue to come back to Ken Kecskes, because Ken, you really have a good handle on, management companies making the right investment path. For a business seeking active management in a portfolio, they'll need expertise, they'll need personnel, they'll need capacity. They'll have to understand their term sheets when they're going into a deal. So as Deborah mentioned, maybe they're going into industrial and they shouldn't really be going there. How does a firm like yours, and how do you help them, build a better portfolio as well as stay away from risk when they're looking at a term sheet?
Thanks, Matthew. I mean, I think one of the kind of the things from the legal perspective that we see when, it's an opportunity to strike fast and hot is, how quickly do you put together your deal and draw your term sheet together? And what we've seen is that sometimes, particularly now when we've got kind of this unsettled, fluid environment where, yes, you don't want to kind of catch the falling knife or whatever, but you still you see this great opportunity. You want to make sure that you structure your term sheet with not only just like your major economic terms, but also, as much of managing that legal risk, particularly if it's a development play, because in those situations, who's going to be responsible for guarantees, the non-recourse carve-outs, all those kind of loan related and financing related aspects, you want to make sure at a very high level are addressed. And one thing I want to just quickly mention, just because Larry mentioned kind of like this little pause or reset, or this time where we're going to be kind of looking at this recession and then maybe boosting right back up, is this is also a good time for family offices to consider either repositioning or re-entitling their assets, because that's time that can be taken now where there's a little bit of uncertainty in market dislocation, and you can add value to your sites. And then when it's time and, borrowing rates are lower, then you can go ahead and make that expansion occur. And I guess the trick really is, because one of the things that we're dealing with right now is kind of construction cost issues and maybe some delay on items, is just kind of timing that right. And again, that kind of goes back to the term sheet, structuring the deal, understanding your timing to make sure all that works so you can take advantage of the timing component.
And let me just follow up one question, Ken. Do you ever get involved in the investment policy statement of a family office? I mean, I know each family office comes with their own set of, okay, here's how we're going to manage our family office. Do you ever deconstruct that and give them ideas?
You know, I know we have here at our firm people that would do that kind of fund work or kind of that programmatic work. And Matt Mangan, who spoke at the very beginning, he is part of that team that can do that kind of work. For myself, my particular practice would be the site-specific joint venture and opportunity, or looking at a particular asset or a suite of assets and understanding the potential development and growth opportunity and the value add opportunity of those particular assets.
Wow, invaluable to a family office. It's really well said. And Pravna, let me move over to you, because what triggered me was the idea of a suite of assets. I mean, if I'm going to go into as an investor into extended stay, I've got three choices. I can go economy, I can go mid-priced, and I can go upscale. So I looked out over the weekend, the RevPAR per room, they're at record highs for extended stay through 2002. So talk about RevPAR, or revenue per room rate, for extended stay going into 23 and 24.
Yeah, and before I do that, unironically, any sort of, perspicacious investor is going to ask whether the talks of inflation and recession and other factors were, fructify, where to park money in real estate. Well, a few other things I'd add to this cocktail, or a little bit of garnish is, there's been moments in history where there's been what we'll call a decoupling of, traditionally GDP growth is highly correlated to hotel demand, meaning if there is for example, a negative 1% decrease in GDP, that's usually a 4% decrease in hotel demand. Today's environment for hotel investments, again, it's a decoupling of that. So we're actually, despite GDP going down, hotel demand, as I mentioned earlier, has gone up, double digits, right? And looking at more the long term, you have two age cohorts. So looking at 2010 to 2030, between 2010 and 2030, there's going to be 40 million more travelers in the age bracket of 25 to 39 and 55 to 79, which are the two largest age cohorts for travel, right? So again, that demand is increasing by 40 million from 2010 to 2030, right? We're in 2022 now. But I would also like to point out that supply growth in the hospitality space has been fairly muted given the construction delays, inflation, construction costs, laborers, et cetera. So for the first time in a very long time, we are adding 2 to 3% of supply on a compounded basis. We're really at less than 1% today. And so for the foreseeable future, given the dislocation. So we have this huge demand and muted supply that's going to be in favor of hospitality for the long term, i.e. family offices think long term, right?
Absolutely.
So I just wanted to go
absolutely. And for extended stay, for hospitality, I know it's a broad category. If I'm a family office, I'm sitting on, cash. If I'm a first time entry, should I come in a fund, in a REIT? Should I come in a fund of funds, or should I come directly to somebody like you and let you allocate my money?
We all know,
Matthew, you cut out there. Can you repeat your question? You cut out there. So can you repeat your question, Matthew?
Pravna, were you able to hear me?
You're good now.
Yeah, I believe so. You were asking, how do family offices allocate money into the extended stay segment? I historically, again, I'm talking through experience and not theory, believe family offices should make direct investments with sponsors. So there's a mutual understanding and what I'll call a charrette, meaning that we are mutually aligned to create systematic and cumulative value for the deployment of capital in this vertical or thesis. And I believe in programmatic constructs, so programmatic master joint ventures, wherein there is skin in the game, and we go out and execute on a thesis wherein the family office and the sponsor work as a team to get things done. There's three really segments alluding back to your original questions. There's the economy, mid-scale, and upscale extended stay segment. For example, the upscale is Residence Inn by Marriott. Today, a Residence Inn costs $250,000 a key to build. An extended stay America, which is in the economy segment, cost about $125K a key to build, and a mid-scale, say a home 2, would cost about $160 to $175. However, I can tell you that the FTE, the full-time employee ratio for a Residence Inn compared to the economy hotel ESA is very, very different. So I can run a 123-room prototype extended stay America with less than 10 employees, a Woodspring Suites with less than 10 employees. My yield on cost for an economy mid-scale, it's not sexy, but it produces a low to mid-teens yield on cost at a very sort of low risk environment. Now, once you move up the chain scale, you're going to have higher operating costs, more bodies operating the hotel. Yes, you're going to probably get higher, reversionary value creation, but your actual cash on cash, right? That's what we focus on. That's why we like real estate, right? We put cash in the bank on a monthly basis. That's what cash on cash yield on cost. We're not future valuations, paper valuations like, the tech valuation world.
Totally understand, because, I'm just trying to think, if I'm a family office watching this today, how do I make that entry point? And, and I'm always looking for sexy. So let's move over to sexy. And I think sexy obviously is storage. So Ken, another question for you.
You're shutting down the rave. What?
So as we continue to talk about storage,
My kids
let's
love
talk about,
that.
you like that, huh? Let's talk about supply chain problems. You and I had a really nice conversation earlier in the week. We talked about supply chain problems. So obviously a couple questions, is it behind us? Is it getting better? How do we handle it? And then let me dovetail onto that to what Pravda just said, because I thought it was interesting. Also, if you can, if I came to you and said, Ken, I'd like to build, 100,000 square foot, facility. I'd like you to manage the construction, manage the process. Talk to me about what are costs go into something like building a brand new facility, and let's say it is 100,000 square feet. So talk about supply chain, and then talk about putting up a facility.
That's all you want? Okay.
That's all I want, because it's sexy, right? Sexy is good.
And I got 2 minutes. All right. Again, there's two ways to build in our sector. One is you go buy a piece of dirt and you build something, and the other is you buy, like we do, a vacant building real cheap from a distressed owner, where the real estate's not distressed, but the owner is. Because, my favorite company in the whole world is Kmart. Because every time you think you found the last empty Kmart, you find 5 more. They're like cockroaches. They never go away. And they're perfect because they're on retail locations, highly traveled, arterial streets, and they're dead. And everybody knows where the Kmart is that died in their market. If you build a new one from the ground up, a single-story facility in a suburban or secondary city, today it's going to run you about $150 a foot, depending what you do. We can get in on the conversions for under $100 a foot, and we get the exact same rent. So that's why we like doing that, because we're buying that building from the distressed seller. We can use the walls, sometimes the roof, sometimes the electrical. They all vary. But it's a different model. It's that repurposing of that asset. Our biggest problem is not supply chain. It's the municipalities. They hate us. Cities don't want us for a very simple 3 reasons. Cities live off sales tax. We don't generate any. That's why on every 4-way intersection of 2 major streets are 4 strip centers, because they generate retail taxes. Secondly, we don't create a lot of jobs. When we're all done, we have 2 employees. That's it. And the third thing they don't like is when we go into that mayor's redevelopment office or the zoning office or the building office and say, we want to build a storage facility on the corner of Main and Main in your little town. what they see in their mind's eye is what we call first generation, a 30-year-old facility from our friends at Public Storage with long metal buildings, orange doors that are faded, cyclone fencing with concertina wire on top, dead trucks and cars parked everywhere, and a couple of Rottweilers running around at night howling at the moon as security. And they say, you want to build what, where? We'll give you a zoning change and a building permit right after pigs fly. So come on back. So that's why we like the conversions, because if that building's been empty and ugly enough long enough, the city finally rolls over and says, you know, Kmart's really not coming back. Now, we don't win all of them. We lost a big one up in Madison, Wisconsin a while back on a big, huge grocery store because the zoning board was made up of a couple of housewives who said, we want the grocery store back. Well, there's no market for a 100,000 square foot grocery store today, anywhere. So we didn't get it, and it's still vacant, and we'll go back in another year or two. It'll still be there. With our institutional clients, they tend to want to sell in about 4 to 6 years because they're all IRR driven. The gal or the guy in the pension fund office who runs the real estate sector wants to be able to go back to their boss or their investment committee and say, look, I knocked it out of the park. I got a 18% IRR when our investment target is 5. You know, give me a pay raise and a bonus. The family offices we have never sell. Every 5, 6, 7 years, we just refinance. And they have huge negative capital accounts, and they just keep pulling money out, and it keeps cash flowing like crazy. We have a couple that are cash flowing. Well, it's not infinity. They have no equity, but you know they're getting checks every month. One of them is getting $90,000 a month on an original $5 million investment, and they've pulled $15 million out of it already in refinancing proceeds. So these are little money machines, and they do very, very well. But again, our biggest problem is not supply chain, Matthew. It's city officials who say, you want to build what, where? Nah, we don't want storage. And there are probably, 15, 20 major cities in America today that have prohibitions against zoning changes for storage. So unless you can find a piece of dirt or a building that's located on a piece of dirt that's already zoned, you're not building anything. LA County's had a moratorium on new zoning changes for storage for 15 years. There hasn't been a new one in San Francisco in 20 years. Wow. You just can't get them changed. You got to find that unique location. But once you do, it's money in the bank.
Love it. Love it. So again, family offices that are out there and you're thinking storage, you're just going to pick one up and, go to 10x.com and, find a property. You've got to have good management. So I think what Ken is really driving at is that if you don't have great management in place, you can really get hurt because who does he buy old storage facilities from? Individuals that think they can do it on their own, and he goes in and scoops them up 2 and 3 years later. So
we love what's been going on in retail the last 3 years. I mean, that's our base product. We're having a feeding frenzy.
Right.
Every single one of the ones we've converted in the last 3 years and have under contract now. Excuse me, not every one. Probably 90% of them are retail boxes. The rest were strip centers, well, that's retail, but a couple of commercial buildings, a couple of warehouses, but you name it, as long as it's got the right demographics that we need, we don't care what it was. We've converted car dealerships, strip centers. One of my favorites is any familiar with Boston, Legal Seafoods, which is the big seafood chain up there. We bought their processing plant near the harbor that they had abandoned because they built a new one, and it was vacant. And we bought it really cheap. We converted it, filled it up, sold it to Extra Space, which is the second largest REIT. The only real issue was getting the fish smell out of there and getting rid of all the feral cats that were living there. But other than that, it's a piece of cake.
So let's stay on that curve. I mean, Larry, let me come back to you if it's okay. And he's trying to figure out, Ken, what are the hot and upcoming neighborhoods? Obviously, he's jammed up by the city. But I know you've been thinking a lot about big data, machine learning, how to predict hot and upcoming neighborhoods, tenant selection. Somebody like you is invaluable to a family office if you were on my board because you would be helping us pivot in the right direction. So talk to us a little bit about that tenant selection, the neighborhoods, and, big data and machine learning.
Sure. Well, the greatest thing is the technology is available now. There's plenty of sources of data to be able to do it. Obviously having, a risk manager, and an investment manager on your investment committee gives you a different view than the than just the deal, individuals. We provide a deeper, broader view, of what's going on. And I like to use research. I like to use models that are objective, that produce, good information for investment decision making. Just as long as the data is good and the models are good, I could use a research-driven strategy to make site selection, submarket selection, individual property selection. You just basically build the model. You can use the machine learning. You just crank the data through, and before you know it, in a fairly short period of time, you've identified, the key targeted submarkets, and then collecting the property level data. You can screen through based on your model to identify the individual properties within those submarkets. And then if you add in some valuation metrics, you can identify properties that are, mispriced. Or what I love to do is to put together a unsolicited offer program and submit, unsolicited offers on the properties, that aren't even on the market, and go to the owner and make them an offer on the exit, from their property. So, using research strategically, tactically, operationally for not only investment selection, but also for operating efficiencies, organic, that drives NOI growth. I highly recommend it. And with the new technology, data, and machine learning applications, it's a great approach. The only problem is real estate people are fairly myopic. They're not technologically oriented. In most cases, they're fairly unsophisticated in their approaches to using data and technology. And that's one of the biggest objections that I have in doing these implementations, is they just don't have a background in tech, and they don't have background in data analytics and research.
So if I'm a family office and I wanted to hire you, can I hire you on a quarterly basis, a project basis? Well, what's the best way to sort of use your services as a family office?
I can do project based, I can do retainer, I can do, medium term. I just signed a contract with a retail private equity firm, for X amount per month. And then a bonus upon delivery of the white paper, and then obviously an additional performance bonus based on the performance of the properties, after a 2-3 year period, once the proof of concept was validated.
Brilliant. Okay, good. So I can grab your services if I need them. So Marty just shot me a note. He told me we have a little less than 10 minutes left. So let's quickly, and I mean, keep it short, keep it tight. I'm going to go one quick more round, and then we'll sum up at the end. And I have one final question for everybody. So again, Deborah, let's keep it tight. Let's keep it short. Let's talk about what's, the big elephant in the room right now, is the idea that we're going to see, I think, defaults. I think we're going to see a tsunami of defaults coming in, that are going to reverberate back to lenders. Lenders are not in the real estate business. They don't want the real estate. They don't want it to go to special servicing. They'd like to help them work it through. So talk to me a little bit about how you're helping the family office that you work with workouts and recaps, if they have any.
Incredibly and fortunately, we have no defaults. This family office is unbelievable with their depth of experience. Average age is 78. One of the heads of the family office, his father lived to 103. So I think it's just the combination of this family office in particular, where they have deep experience in banking. They were heads of divisions of major global banks. They have decades, 5 decades of development experience all over the world, just about every major asset class, mostly hotels, and like 70%, and multifamily senior housing. So, so they understand banking, they understand taking risk, mitigating risk, and taking calculated risk. So thanks to all that experience, we have none, but we're getting a slew of activity because of other lenders and institutions not lending on a lot of programs, particularly construction. For example, hotel construction, there's literally a handful of construction lenders in the country that will even touch that. So we're getting poured with a lot of requests. And Yeah, so
Right, because
there's a
there's a
lot of
lot of
dry
debt
powder.
coming in. The debt coming in that's going to go to the special services, the debt coming in that's going to go to the banks. The banks aren't in the real estate industry. I think they're going to be swamped. So, if I'm you and I'm your firm and working with that family office and they are liquid, I think there's going to be a multitude of great assets on the street. And I think everybody's really thinking the same thing, that special services or banks are we're going to be inundated with requests to look at their portfolio. So let me sort of give a 30,000 foot, question to each one of you, and we'll move quickly because we're, under that sort of 5 minute range. Is let's talk about your backyard, right? Some of you are in the Northern California area, others of you are, not. What's going on in your backyard? So, Ken Nitzberg, what's going on in your backyard? What do you see? Is retail in trouble? Are you seeing new family homes growing? Are there new community colleges getting done? Is Stanford buying real estate? What's going on in your backyard?
Oh, we don't have anything in our backyard here in Northern California, so it's not relevant to me. We're in 27 states, but not, and we are in Sacramento. We're all over the what's called the Inland Empire, which is Palm Springs area, and we're in 26 other states, but nothing here in the immediate Bay Area. I mean, we like to go into markets that are difficult, but we're not crazy.
But what about
cities here in the
Oakland?
Bay
What
Area
are you
don't want
seeing?
us.
Yeah, what are you seeing going on in Oakland? What are you seeing going on in San Francisco, San Mateo, Silicon Valley? What's
The
happening
same
up
thing
there?
we're seeing across the country. We're seeing dead retail. I mean, we're in an office complex that has 3 buildings, and the manager of the buildings called us today and said another one of our tenants is bailing. You want any desks? They're giving them away. And this is 3 major towers that are 16 stories in Emeryville, and the buildings are better than half empty. So, I mean, I wouldn't want to own a portfolio of office buildings today, and I wouldn't want to own a portfolio of retail today.
Got it.
I'm happy where we are.
Let me move on to Pravna. Pravna, talk to me about your backyard. What you're seeing.
Marty's butting in.
So imagine there more specialty self-storage. Like you hear about these people are like robot self-storage, and then you have guys who are like, they will go and I guess they rent a whole bunch of self-storage units and then they apportion it among many people. It's like a portfolio self-storage. And like, why aren't you guys using big data? Why isn't there like self-storage dedicated to like women's shoes, for example?
Marty, I can't touch that with a 100-foot pole. My immediate next door neighbor, for everybody's edification, is Rita Moreno. She's got 800 pair of shoes in the house from every movie she's ever been in. Okay, I have 4 pair. Okay, so it's I can't understand that.
How long were your parents married? When are you getting married?
Sure.
And you're going to need it in 2 years, right? Stuff like that. I mean,
Well, I mean, there's always somebody who wants to be a disruptor. The one of the bigger ones today are these pickup and delivery services like Shutter.
right.
Okay, and they've given up, and they're out buying existing self-storage facilities now because their prices are 4 times as much. Remember, there's a very simple rule in the self-storage business. The 3 things we do: we don't take control of your goods. We're renting space, so we have no liability. If it burns down, gets flooded, gets stolen, your problem. No different than when you rent an office and put a desk in. When someone does the pickup and delivery, they got some kid driving that semi through Manhattan, picking up boxes. And if he decides to drive down to Florida and sell the stuff on the way, you're in a world of hurt. You have liability. We don't have any liability for what you store. We want to keep it real simple. There have been, we have a number of stores we bought over the years that had sections for wide storage. We couldn't rent it. So we took it out and put regular storage in. Simple, basic blocking and tackling. It works just fine. It ain't broken. We don't need to fix it.
Wow. Okay, good.
Pravna, quick question for you. What are you seeing in your neighborhood? What's new? What's different? Well, just give us sort of a ground level view of what you see out there.
Yeah, we're geographically agnostic. What we try to do is find true supply demand imbalance in the hospitality segments that we are either developing or acquiring. So we not only focus on extended stay developments ground up, but also lifestyle hotels. So we like picking up, again, assets that have been mismanaged or that are physically distressed and convert them to true lifestyle boutique hotels, which are driving substantial RevPARs, especially in this post-COVID pent-up demand scenario. But we love in terms of extended stay, what our big data system does is we look for where infrastructure dollars are going in, where are the traveling nurses, occupying jobs, healthcare, that type of thing, statistics. And then we will go build in those markets. We love periphery markets of growth markets, for example, Texas, like Pflugerville, where there's logistic parks and allied infrastructure services coming up and roofs being built, because all this constructions needs, subcontractors to build these things, and they need to put their head in the bed, right? And extended stay is the best asset for that. So
thank you.
So the market for our lifestyle stuff.
Love it. I think the RevPAR is going to be so important going forward. So Deborah and obviously Ken, you're the last two. So let me change the question. Deborah, what's the best piece of advice you've received that's helped you to succeed in your industry? And what advice would you give to the next generation?
One word: conservatism. Just always build room in, cushion, just a conservative play. As we build for legacy or build for our retirement, we just use resources faster than we can that we can earn or build. And so I'd say conservative, like our family office. When we underwrite deals, we're looking at lower leverage now. We're looking at taking more interest reserves.
I'm really
from
talking
our
about
borrowers.
you. I'm talking about you. What's the best piece of advice you've received that's helped you succeed?
I think keeping an open mind and really understanding all kinds of segments. There's so many dynamics and in our industry, and just really keeping an eye open, because we're all connected. So every industry is connected to the next. And so I think really staying on top of information. There's just so much information coming at us. So thank you.
No, you're welcome. A great answer. And Ken, and obviously, this is your show. And Ken, we want to thank you again for allowing us to use your conference space and your room and be here today. So I'm sort of going to give the floor to you and talk maybe a little bit about your firm and a little bit more about, what you do. But, we want to thank you again for giving us the ability to be there today.
Well, thank you, Matthew. I appreciate that, and I'm very happy that we were able to have everybody here. It's been a great conference. I think just the one thing that I'll add, kind of to your last question, which is, kind of be ready for change, was kind of the advice that I've seen. And as a lawyer, particularly seeing the legislative changes that we've seen in like the last 5-7 years, and wanted to mention housing just really quickly, how we've seen, the state legislature just really move aggressively on housing. And there are now laws on the books that make it easier for family offices to build multifamily product. There was a lot of concern, a decade ago about, and there still is a little bit about concern about CEQA, but there's fast tracking legislation now. There are rules on the books to increase certainty for developers. The legislature's finally got it. And so this is kind of one of those good changes that we've seen out of California, in that there is the ability for family offices to kind of realize on their investments in the residential space. So keep track of those changes.
Brilliant. Thank you, Marty. Thank you. And back to you.
Wow, guys, great job. You guys are so smart. No laughing matter. However,
and sexy.
Thanks. And Mr. Ken here, but he's my brother. Anyway, so it's fantastic, and what a great reception we had yesterday, and what a great day today. I want to thank Deborah, who's been instrumental in getting this space for us, and we're gonna go off and have dinner. So looking forward to that, and we're back tomorrow at 9:30 a.m. We're gonna start. So looking forward to it. Thanks so much for making it, guys. And we'll be seeing you tomorrow. Thanks so much.
Thank you.